and evolving economic environment, we remained disciplined. We reinforced our core. We fortified our systems. We strengthened our strategic posture. This focus delivered results and showed strength in consistency. Our cost-to-income ratio improved to 64.29% from 73.56%, a reduction of 927 basis points. Our return on equity increased to 12.46%. Our consolidated net profit grew by 71%, reaching $36.9 billion, the highest on record. This growth was influenced in part by the gain from the sale of a subsidiary as we continue to streamline operations and sharpen our focus on our core businesses. But financial performance alone does not define progress. Throughout the year, we remain guided by our 4 strategic pillars: strengthening customer relationships, delivering as a one-stop shop, optimizing efficiency and productivity, maintaining world-class standards. To drive operational efficiency, unlock synergies across subsidiaries, elevate service delivery, and enhance the group's ability to deliver consistent value to customers and shareholders, we established 2 strategic centers of excellence across NCB and Guardian: the Investment Management Center of Excellence and the Pension Fund Administration Center of Excellence. We also diversified our funding profile through the successful issuance of a $225 million senior secured note in the international capital markets. At the heart of our strategy is a clear belief: financial performance must translate into real value for customers and sustainable returns for our share.
Make secure and faster payments with NCB Pay. NCB Pay stores all your NCB credit and prepaid card and reduces fraud by hiding your card information when you pay. So you can just tap and go with your Android phone. Don't just pay. NCB Pay. Download today.
Today's woman is not just an entrepreneur, a mother, or the girlfriend that gets all the girls together. She's all that and much more. We call her a queen. She's driven to live life to the max, and nothing should slow her drive down. That's why Guardian General's Queen Guard Motor Insurance was created with this woman in mind. Delivering benefits like 24-hour roadside assistance, uninsured motorist protection, windscreen coverage, replacement of personal belongings, speedy claims settlement, and so much more at affordable premiums that won't break your pocket. For more information, contact your broker or call us at 876-935-6681 or toll free 888-468-3474.
When your business starts growing, sometimes the tools you rely on can start holding you back. It's time for an upgrade. Get road ready with NCB. Enjoy monthly payments as low as $12,033 per million borrowed. WhatsApp Wheels to 876-613-9160 to get started. Conditions apply.
In a world where scams lurk around every corner, NCB is working tirelessly.
Calm down. Good morning, ladies and gentlemen. Welcome to our Q3 Investor Briefing 2024. You're going to hear a lot about what we have done over the last quarter, year to date, etc., etc. So I will not spend any time dwelling on that. What I'm going to spend some time doing is talking about where NCB is going and in fact, what will inevitably determine our future results. The future results of any company, including NCB, is a function of its culture and how aligned the organization is to a culture, a unified culture. And what we are doing here at NCB currently is making sure that our cultural reset, we're doing a cultural reset. And the cultural reset is revolves around the word care and the acronym CARE. As we all know, the word care has some warm connotations. It suggests selflessness. It suggests service. It suggests empathy. That's the word care. It's very warm. And if you think about it, wouldn't you want to make sure that the reputation of your own family on a personal basis be one of care? An institution should be no different. And hence, to us, that is our guiding light with respect to our culture. In terms of the acronym, what do the letters C, A, R, E mean to us? Firstly, C it's collaborate. Collaborate with whom? With all our stakeholders. A, accountability. Accountability to whom? To all our stakeholders, internal and external. R, respect. Respect to whom? All our stakeholders, internal and external. And lastly, in everything we do, we ask ourselves the question, what standard am I operating at? And no one is going to say I'm operating at mediocre or sub-mediocre standard. In our case, we put it out there. The standard that we are operating at is one of excellence / mastery. That's where we're going. So the word CARE, the acronyms CARE, is very, very meaningful. It's our driver of our behavior. We want to be measured by it. That's the reason why I'm starting off with it. And I'm putting it out there publicly so the public can say, starting with Chairman, you're not acting in a way that shows honor to CARE the word or the acronym CARE. So we want to make sure that we lead by example, starting with the chairman and permeating right through the organization. That's how we're going to build the best business, not only in Jamaica, not only the region, but in the world, because we are certainly very high aspirational. So in summary, what will determine future performance is culture. And our culture is summarized by the word CARE. So with that, I'd like to pass the baton over to Malcolm, CFO for the group, who will walk you through the results of the group. Thank you very much.
Thank you, Chairman, Honorable Michael Lichin, Roberto Almeida, Group Chief Executive Officer, Dave Garcia, Group General Counsel and Chief Administrative Officer, directors and executives, shareholders and all stakeholders, good day, and thank you for joining us for our third quarter investors briefing. This morning, I'll provide an overview of the group's financial performance for the 9 months ended June 30, 2026, highlighting the key drivers of the results, segment performance, and the financial position. For the 9 months ended June 30, 2026, the group recorded consolidated net profit of 18.6 billion compared with 30.5 billion in the prior year. Net profit attributable to stockholders of the company was 13.3 billion, compared with 19 billion for the corresponding period last year. The lower net profits for the current year was primarily driven by the non-recurrence of the 15.1 billion gain recognized in the prior year from the disposal of the Netherlands-based insurance brokerage business. Operating income declined by 14.1 billion, or 13%, to 96.2 billion. The movement was largely influenced by the non-recurrence of the prior year's disposal gain and a reduction in other gains from foreign currency and investment activities, which were partially offset by higher net interest income and higher insurance service results. These factors also contributed to the overall decrease in net revenues from banking and investment activities to 86.8 billion, 23% down from the 112.5 billion in the prior year. Insurance activities continue to make a positive contribution, with insurance service results improving to 19.9 billion, representing a 30% or 4.6 billion increase. Insurance revenue increased by 3% to 112.3 billion, while insurance service expenses rose by 33.8 billion, or 47%, mainly due to higher claims resulting from Hurricane Melissa. This was partially offset by reinsurance recoveries, which resulted in an overall reduction of 34.8 billion in net expenses from reinsurance contracts. Net insurance finance expenses also declined by 7 billion, or 40%, to 10.6 billion, due to the impact of net fair value losses on certain investment-linked products. Operating expenses were lower as we continue to focus on cost discipline, which led to these expenses declining by 3.5 billion, or 5%, to 70.8 billion. However, the overall lower reported profit for the current period resulted in return on equity of 8.57%, compared with 13.97% for last year, return on assets of 1.02%, compared with 1.73%, cost to income of 70.40%, compared with 63.43% for last year. If we normalize the prior results by removing the one-off gain of 15.1 billion, the current year's return on equity, return on assets, and cost to income would have improved by 148 basis points, 15 basis points, and 244 basis points, respectively. The core current year performance metrics therefore reflect positive momentum and indicate that the group continues to move in the right direction. Excluding the prior gain, core year-to-date net profit improved by 21%, or 3.2 billion, and core net profit attributable to stockholders of the company improved by 38%, or 3.7 billion. The main drivers of the performance include insurance service results, which improved by 30%, driven mainly by higher insurance revenue. This reflected stronger revenue performance across the insurance portfolio in both the life, health, and pensions, and property and casualty segments, and reinsurance recoveries partially within the general insurance business, serving to largely offset the claims from Hurricane Melissa. Net insurance finance expenses declined by 40%, mainly reflecting valuation movements in the underlying insurance investment portfolios and the related reduction in policyholders' liabilities. Net interest income increased by 3.6 billion, or 6%, supported by higher income from investment securities and lower interest expense on customer deposits, repurchase agreements, and securitization arrangements. This was achieved notwithstanding negative loan growth as the group continued to focus on portfolio optimization and asset quality. Operating expenses declined by 5%. The reduction was driven by lower operational losses, management fees, technical consultancy and professional fees, as well as lower insurance costs, underscoring the group's continued focus on cost optimization and operational efficiency. There were, however, increases in depreciation, amortization, finance costs, and asset tax. The favorable movements in various income streams and operating expenses were partially offset by the decline in gains from foreign currency and investment activities by 15.2 billion or 92%, reflecting market-driven valuation losses and equity investments and lower realized gains from the sale of debt securities. Our diversified business model supported the group's performance with strong contributions from all 7 segments. 5 of the 7 segments recorded higher profits year over year. Life, health, and pensions remained the largest contributor, despite a 51% reduction in current year profits due to the non-recurrence of last year's one-off disposal gain and higher fair value losses in this year. The performance was supported by improved insurance service results, driven by higher insurance revenues, lower claims, and directly attributable expenses, as well as lower net insurance finance expenses. The general insurance segment also recorded a profit, despite being down 20% due mainly to the impact of net claims as a result of Hurricane Melissa. The overall operating profit for the current period was supported by higher insurance revenue and reinsurance claims recoveries, which demonstrated the value of the group's approach to risk management and disciplined underwriting. Treasury and correspondent banking remained a key contributor, generating operating profits 2% higher than the prior year. This segment continues to play a central role in the group's liquidity management, balance sheet positioning, and foreign exchange activities. Wealth, asset management, and investment banking reported operating profits 53% above the prior year, supported by stronger net interest income, fee-based income, and investment activity. The segment benefited from continued client activity across wealth and asset management products and disciplined management of funding costs. The payment services segment delivered operating profits of 43% over the prior year. This performance was supported by continued growth in card issuing and acquiring volumes, increased transaction activities across digital and electronic payment channels, and ongoing customer migration toward more convenient payment solutions. This segment remains an important contributor to fee income and reflects the benefits of continued investments in digital capabilities, merchant services, and payments infrastructure. Corporate and commercial banking recorded operating profits 14% higher, reflecting improved net interest margin and reduced credit impairment provisions. Consumer and SME banking reported operating profits of 148% over the prior year. The improvement was supported by higher margins and lower credit impairment provisions, reflecting disciplined pricing, active portfolio management, and continued focus on credit quality. While loan growth remained subdued, the segment continued to deepen customer relationships, support small business clients, and maintain stable earnings within the banking franchise. The performance across all segments reinforces the value of the group's diversified business model, which continues to drive our revenue base and support more resilient earnings across varying market conditions. As of June 30, 2026, the group maintained a strong and stable financial position, supported by a resilient balance sheet and solid capital base. From a capital perspective, all regulated entities remained well above the applicable minimum requirements, providing the group with financial flexibility to support its strategic priorities. Total assets increased to 2.43 trillion, up 2% or 45.2 billion year over year. Investment securities, including pledged assets and reverse repurchase agreements, remained a major earning asset at 1.29 trillion, increasing by approximately 40 billion or 3% over the prior year. Loans and advances declined by 3% to 606 billion as we focus on portfolio optimization and asset quality. Customer deposits increased by 68 billion or 8% to 874 billion, remaining the primary source of funding and reflecting continued confidence in the group. Insurance contract liabilities increased by 1% to 568 billion, compared with 563 billion in the prior, reflecting continued growth in the insurance portfolio. Total stockholders' equity increased by 14% to 274 billion, while equity attributable to stockholders of NCBFG increased by 13% to 214 billion, reflecting continued growth in shareholder value. The book value per share increased by 13% to $82.92 as of June 30, 2026, compared to $73.43 in the prior year. Also, the Board of Directors, at its meeting on August 13, 2026, approved an interim dividend of 50 cents per ordinary stock unit, payable on September 11, 2026, to stockholders on record as of August 28, 2026. In closing, while the comparative results were affected by the prior year's disposal gain, the group's underlying performance continues to strengthen. I would like to acknowledge our teams across the group for their continued focus and commitment throughout the period. Their execution, particularly in a more challenging operating environment, has been central to maintaining stability and supporting performance. I also extend my appreciation to our customers and shareholders for your continued trust and confidence in the group. As we progress through the remainder of the financial year, we remain focused on navigating the operating environment and delivering sustainable value for all stakeholders. Thank you, and I will now hand over to our Group Chief Executive Officer, Robert Almeida.
Thank you, Malcolm. Good morning, all. Good morning, Chairman, directors, colleagues, shareholders, analysts, members of the media, team members. Good morning. For the last 2 quarters, I have said that 2026 would be a transition year for the group, a year in which the heavy lifting of stabilization and restructuring would continue to give way to a more predictable, more disciplined, and more sustainable operating rhythm. That transition is not only underway, it is becoming clearer. This quarter amplifies what we have been saying for some time. The progress we are seeing is not accidental. It is the result of deliberate choices, disciplined execution, and perseverance over several years. We stayed focused when the work was difficult. We remained disciplined when the benefits were not fully visible. And today, the evidence is increasingly clear that NCB Financial Group is on the right track. 3 years ago, our priority was clear. We needed to strengthen the foundations of the group. We focused on our balance sheet, strengthened governance, sharpened our focus on efficiency, and began reshaping the organization around businesses and capabilities that could scale. Today, the conversation is changing. It is no longer only about strengthening NCB Financial Group. Increasingly, it is about what a stronger, more disciplined, and more capable NCB Financial Group can now do. Financial strength matters because it creates options. It gives an institution the capacity not only to withstand uncertainty, but to act deliberately when opportunities arise. That is increasingly relevant to NCB Financial Group. Our balance sheet is considerably stronger than it was 3 years ago. Our equity base is substantially higher. Our debt has passed its peak and is now reducing, and we intend to accelerate that reduction in a disciplined way. Our cost of funding is also declining. These are not just abstract financial metrics. They improve our flexibility. They increase our ability to invest. They strengthen our capacity to grow. And over time, they enhance our ability to create and return value to our shareholders. That is what strength gives us. It gives us options. But financial strength alone is not enough. An institution must also have the capability, governance, leadership, and execution discipline to use that strength well. The work of the past 3 years has been about more than just stabilization. It has been about change and evolution. We have been deliberately building a group that is stronger, simpler, more integrated, and more capable of sustaining performance across different market cycles. That does not happen in one quarter. It is built layer by layer through governance, leadership, operating discipline, capital allocation, customer focus, and execution. This quarter shows that those layers are beginning to work together. Our board is more mature in its understanding of the business, its priorities, and the execution choices required to create long-term value. Our leadership teams across the principal operating companies are firmly in place. Governance structures have strengthened. Group functions are becoming more integrated. Succession planning, continuity, and leadership depth are giving the organization greater resilience. That matters because our strategy has never simply been about having a collection of successful companies. Being part of NCB Financial Group should make each of our businesses stronger. The group itself should create value beyond what each company could create on its own. Our strength, therefore, is increasingly institutional. It is not dependent on any one person, one company, one country, or one product. It is increasingly people-led, capability-driven, and execution-centered. Over the past several years, we have been building that capability through our centers of excellence. We have executed on the pension fund administration and investment management centers of excellence in Jamaica. These are important steps in building deeper technical capability, stronger operating focus, and more scalable platforms within the group. Through Clarion's completion of the acquisition of NCB Cayman's operations, we will have advanced the establishment of our centers of excellence for international financial centers. Subject to regulatory approval, we also intend to combine NCB Merchant Bank, Trinidad and Tobago Limited, with Guardian Asset Management, Trinidad, to create a wealth management and capital markets center of excellence serving the Southern Caribbean. These are connected steps towards creating a more integrated, scalable, and efficient financial group. We said we would simplify the group, improve capital allocation, and build capabilities that could support future growth. We are executing on those commitments. At the same time, our internal restructuring continues. This work is not designed for short-term effect. It is designed to create a stronger operating model, clearer accountability, better use of capital, and more consistent execution over time. We saw the importance of institutional strength following Hurricane Melissa. For the families and communities affected, the hurricane was devastating. Homes and livelihoods were affected. Businesses were disrupted. Many customers needed their financial institutions most at a time when normal life had been turned upside down. For us, resilience in a moment like that cannot simply mean strong ratios on the balance sheet. It means being able to continue serving. It means customers being able to access their money. It means businesses having a financial partner as they recover. It means our insurance businesses having the capacity to respond to legitimate claims. That is why institutional strength matters beyond NCB Financial Group itself. It makes us better able to stand with the markets, economies, and communities we serve when they are tested. The progress we've made is also becoming increasingly visible in our performance. As Malcolm outlined, our underlying earnings are becoming more predictable, with a core recurring earnings profile now emerging in the region of $5 to $6 billion per quarter. There will always be volatility. Markets will move and unexpected events will occur. But what investors should increasingly be able to see through that volatility is the underlying earnings power of the group. We are also making progress on efficiency. Our cost-to-income ratio continues to improve, although it remains above our target of approximately 60%. Return on equity has strengthened, although it remains below our 15% hurdle. So while we recognize the progress, there is more work to do. It is also important to look at these metrics on a meaningful underlying basis. Excluding the prior year gain on disposal of the subsidiary, return on equity, return on assets, and cost-to-income ratio would have been 7.09, 0.87, and 72.84%, respectively, in the prior year. Against that base, our current year-to-date ratios are tracking ahead or favorably compared to the prior year. That context matters. It shows that the improvement is not simply a function of one-off items. We are replacing one-off items with a consistent, recurring earning stream. It reflects a business that is becoming more disciplined, more efficient, and more capable of generating that sustainable performance. Efficiency, governance, and customer experience remain firmly at the center of our strategy, as does our focus on being brilliant at the basics. These are not initiatives for one quarter or for 1 year. They are disciplines, and when applied consistently, their impact compounds. Reasonable revenue growth combined with greater operating efficiency supports stronger recurring earnings. Stronger recurring earnings, better capital allocation, lower debt, and lower interest costs reinforce one another. None of these things alone transforms the institution, but together, over time, they can. We are also seeing encouraging signals from the market. Our bonds issued locally and internationally have strengthened, and our share price has appreciated. We believe these are indicators of increased investor confidence in NCB Financial Group, locally, regionally, and globally. That confidence matters. It tells us that the market is beginning to see what we have been deliberately building: stronger balance sheet, clearer earnings visibility, better governance, more disciplined execution, and a group that is increasingly investable. Our brand is also benefiting from that clarity. A stronger institution with a clearer strategy and more consistent execution becomes easier for customers to trust, easier for partners to engage, and easier for investors to understand. Confidence also creates access. Stronger access to capital markets gives us greater capacity to invest in our existing businesses and greater flexibility to respond when strategic opportunities arise. Combined with the capabilities we are building through our centers of excellence, it also allows us to think differently about growth. As we begin looking towards 2027, our expectations remain disciplined. We're not building plans around extraordinary assumptions. We are looking for reasonable top-line growth, continued improvement in operating efficiency, disciplined execution across the group, and stronger capital flexibility. As our operating companies generate stronger earnings and dividend flows, while debt and interest costs at the holding company decline, NCB Financial Group should have increasing financial flexibility. That creates greater capacity to reinvest where we see attractive returns, and over time enhance the value we are able to return to our shareholders. Beyond organic growth, our centers of excellence create capabilities that can scale. If we build strong investment management capability in one market, we should ask, where else can that capability create value? If we strengthen our international financial services platform, we should ask, where else can that platform compete? When institutional capability is combined with financial capacity, regional expansion, strategic partnerships, and selective acquisitions become possibilities. Not growth for growth's sake, but opportunities where we have the capability to succeed and where we believe we can create sustainable, long-term value. Perhaps that is one of the clearest signs of how far we have come. 3 years ago, the questions being asked of NCB Financial Group were fundamentally about resilience. Could we strengthen the balance sheet? Could we improve efficiency? Could we simplify the organization? Could we strengthen governance? Could we deliver more consistent performance? Those were fair questions, and quarter by quarter, we've been answering them through execution. Today, I welcome a different question. Where will the growth come from? That's the question people ask when they have confidence in the foundation. It's the question they ask when stability is becoming expected rather than exceptional. And it is the question management should be challenged to answer in the next phase of NCB Financial Group's development. We do not have to chase every opportunity, but we should have the strength to recognize the right ones, the capability to execute them, and the financial flexibility to act when they appear. That is the institution we have been deliberately building. As we approach the final quarter of our financial year, our focus remains consistent. Efficiency, governance, and customer experience, disciplined capital allocation, and long-term value creation. The world will continue to change, markets will move, new risks will emerge, and so will new opportunities. Our responsibility is not to predict every one of them. It is to build an institution strong enough to navigate them and capable enough to take advantage of the opportunities they create. 3 years ago, our priority was resilience. Today, our opportunity is disciplined growth. For the last 3 years, we've been building NCB Financial Group's strength. Strengthen the balance sheet, increase the equity, reducing debt, intended and accelerate that reduction. Improve governance, advance centers of excellence, strengthen leadership depth and continuity, remain focused on execution, and we are now seeing the signs of confidence, momentum, and greater investability. The next chapter is about what we do with that strength. To our shareholders, thank you for your continued confidence. To our customers, thank you for trusting us every day. And to our team members across the group, thank you for the discipline, professionalism, and perseverance that have brought us to this point. The progress we are seeing is not accidental. It is deliberate, it is disciplined, and it is gaining momentum, and we intend to keep building on it. And with that, I'll turn it over to Dave Garcia.
Thank you, Rob. So the first question that I have is, in fact, for you. You have spoken about the Centers of Excellence for Investment Management and Pension Administration. How should we as investors see these types of moves? Are they primarily for client experience or cost efficiency or something else? And also, what's your assessment as to how well they're working and what other opportunities there may be to leverage that type of approach?
So that's actually a great question. A great question because a question I'm happy to get. So the Centers of Excellence achieve many different objectives. So just to give you a few different examples. First of all, if you just look at the Pension Fund Administration and the Investment Management Centers of Excellence, what they do is they combine our capital base and our talent pool so that we can provide a better customer experience, a better value proposition to the customer, more choices, better products, better execution of those respective business segments. So better advice. It's all about that. I'd say is primarily about customer experience. It's about collecting our resources, consolidating them, focusing them, so that we can bring a better value proposition, a better customer experience to the customers in that space. There are other centers of excellence that we talk about that we don't specify as much, but we have been working on. We effectively have a legal center of excellence across the entire group today. We have a risk management center of excellence across the entire group. So we've been focusing on integrating more while maintaining the independence of each of our respective entities, but bringing them more together as a family to share best practices, to be more coordinated, to learn from each other. And so that we do have legal, finance and accounting, auditing, risk management in centers of excellence. And those would be about, not so much about customer experience, but those would be more about making sure that we have better governance, better risk management, better control, and better quality execution. And so the combination of those two things, if you bring efficiency and customer experience and you get them better, the third part it enables actually growth, because otherwise growth is to scale inefficiency, and scaling without control is risky. But when you want to pursue and accelerate growth, you actually want to do it when in a position where you have greater control of the business and you're able to scale business on capabilities that are already efficient, and therefore you actually create a virtuous cycle of being able to grow, increase your margins at the same time, and reduce risk all at the same time. And so that's what the centers of excellence have been about. And in the process, they also allow us to be more capital efficient. And so they've enabled that. So it achieves a number of objectives that all come together.
All right. Thanks, Rob. Another question for you relating to the cost to income ratio, which I think as outlined in both your and Malcolm's presentations has risen, although it's appreciated that this would have been heavily impacted by the fact that last year there was that extraordinary gain. How are you seeing where NCB as a group is now in the drive to improve its efficiency ratio?
Yeah, so we're currently probably in the mid 60s, like currently like at the quarter. Malcolm was talking about the 9-month or kind of look back 12-month type numbers. You look specifically at where we are in the quarter right now, and we're in the mid 60s thereabouts. And the goal is to get below 60% and then move towards 50%. And so that's our objective, is to get it down below 60. We're on a good trajectory to get there right now. And like I said, currently run rate Q3 in around the mid 60s, and look for that to continue to move down. One of the things to keep focusing on is the absolute amount of operating expense in our business, which continues to decline, whilst at the same time our income is growing. And remember, the income that we're reporting now is pretty well recurring earnings. If anything, in the quarter we had a little bit more, not much in the way of market volatility. So it was pretty well a standard quarter. And so that's recurring earnings and costs being maintained. And if we can continue to maintain that small growth in, reasonable degree of growth in operating income while the costs are held, that in of itself will continue to bring the cost income ratio down closer to 60% and then below that.
All right. Thanks, Rob. I have another question here about cost, about the efficiency ratio, but specifically in relation to the bank. So I'm gonna direct this one to Cherie Martin. Cherie?
Morning. Hi, Dave. I'm hearing you.
Morning. Okay. So here's the question. Do you think there is significant short-term opportunity for NCBJ to improve its efficiency ratio, or should we be expecting the ratio to more improve only incrementally in the next several months?
Thanks for the question. So I think it's a combination of both. We are seeing incremental improvements that sustain over time in terms of resetting our cost structure. And I'm speaking about cost as one driver for that cost income ratio. And that is a sustained effort over time to continue to reorganize how we do things. We have exploited technology to an extent, but a lot of our processes are still manual in nature, which require a certain type of cost structure. And to the extent that we can improve those processes to make them faster, simpler, more, I would say, customer-centric in every respect, meaning the experience for the customer, the safety and the security, the access, the reliability, and the convenience that they would demand from how we do business. Once those are also being optimized, then we are going after those opportunities. In a lot of instances, however, some of those changes have to take place over a longer period of time. And so we're advancing on cost restructuring such that there is more sustainable reset of how we do business. And that will be incremental, and that will influence the ratio as we've seen in the last year and a half, thereabouts. But in the other element for improving our cost to income ratio would be on the growth side, on the revenue side. And so to the extent that as Rob mentioned, we can advance in areas of growth, then those revenues will support a cost infrastructure that we have, even while we continue to improve that cost infrastructure. So I would say it's a combination.
All right. Thanks, Cherie. Next questions are for Ian Chinapu. Ready
Good
for us,
morning,
Ian?
everyone. Good morning, investors. Good morning, colleagues.
Morning. So there has been some publicity about the rate of processing of claims by insurers in the wake of Hurricane Melissa. Could you comment on how Guardian has been doing in that regard, and specifically, if you have the information handy, what percentage of the claims have been settled?
Oh, good question. And I'll give an update. So as of June, we were in the region of 70%. I think we're approaching 75 to 80% now, but of course, we'll update more exactly at the next briefing. The biggest challenge has been, of course, with a major event like this, the dependence on the entire industry on our loss adjusters. And we have learned a lot of lessons from that, because of course we need to get the loss adjustment in order to process the claims, in order to present our insurers, etc. So we are making significant progress there. There was a slow start, and then we were able to pick up. But as a result of that, in our northern territories, not just Jamaica, we have introduced our no average product, which is a faster way for us to actually work with our policyholders to get those claims settled, where we will now be providing a range of estimates in terms of the properties preemptively, so that we'll be able to process claims faster and with less input from the loss adjusters. So we have taken those learnings, we've launched that service, and I think we're in the process of expanding it into the Southern Caribbean. I believe even personally, my properties are now in the beta test for Trinidad. So we want to do this everywhere, and that will improve our claim settlement timeframes. But in terms of Hurricane Melissa, we're over 70% now. We really want to get this done, because we understand this is why we're needed. I think the entire industry has faced that. In Guardian, we've also, in our claims processing, we've included our entire team from across the region to support our Jamaican team, which is how we've been able to get some traction there going. But the main challenge has been on the combined industry use of the external resources, because we do need, in the current situation, independent loss adjusters. But as we go forward, our no average system will help for many of our policyholders in the event of anything in the future.
All right. Thank you, Ian. And a second question for you. This now is in relation to the sale of NCB Merchant Bank Trinidad and Tobago to Guardian. Now, can you give any sort of update on what the status of that transaction is? And, in what way is Guardian seeing that transaction as beneficial to Guardian and to the group as a whole?
Okay, well, very live process, and my colleague Angus Young is here as well. He's the seller, we're the buyer. But we are in the process. So we've announced the intent to do so, and we've announced that in April. We're in the process of obtaining our no objection from our regulators, and we're very live. We even had calls up to yesterday. So we believe that we're making progress. We really hope that come our new fiscal financial year, October 1st, that the NCB Merchant Bank Trinidad and Tobago will be acquired by the Guardian Group. So that's our goal, and subject to all regulatory approvals. And of course, it's a team we know very well. It's an exceptional team, exceptional business, and it will actually create, as our group CEO would have shared, an investment, an asset management center of excellence in the Southern Caribbean, which will support Trinidad and Tobago, the Dutch Caribbean, Barbados, the Eastern Caribbean. And that business has been doing very well independently, but together we expect we'll be able to achieve all of those benefits that Group CEO just mentioned in terms of operational efficiency, leveraging talent, accessing a larger capital base, because in that business, the larger the capital base, the bigger the deals you can underwrite, the bigger deals that you can do, you're at the table. And we've already been very active there. We've done over $5 billion in underwritings and placements in the last 2 years in that space. And I probably even understated that. But ultimately, when I add the NCB Merchant Bank team's numbers as well. So ultimately, what we have is going to be something that, and I hope I'm saying this publicly, and I hope I don't attract some of the other players in the market, but we're coming for that. So we're coming into the market, and we're there, and we've built the expertise. So this Center of Excellence will also be able to support the regional sovereigns, we support the Southern Caribbean regional sovereigns, support the large corporates to offer a more. We'll now have a full suite of our licenses, probably the exception of retail banking, but with all the other, there'll be a foreign exchange license, there'll be deposit taking, we'll be able to do more repos, etc. So, and of course, we have our existing mutual fund business, we have our existing asset management and private wealth business. It's a match made in heaven. So that work is ongoing. We're very live, and we're working, and we're hoping to meet all of the requirements of our regulators in order to progress that transaction and get final board approval to do this.
All right. Thank you, Ian. And we're going to move along to another Ian now. Ian Truron, with a somewhat similar type of question to that last one that was asked of Ian Chinapu. And it's this: several months ago, Ian Truron we can bring up. Several months ago, NCB announced the sale of NCB Cayman to Clarion. And also looking here to get some sort of update, if you can, on the status of that transaction, and also to help us to understand in what way is Clarion seeing that transaction as beneficial to Clarion and, of course, to the group as a whole.
Thank you very much, Dave, for the question. And let me just say from the outset is I share the exuberance and the excitement that my namesake Ian Chinapu just shared as well. So the transaction is progressing well. Regulatory approvals have been achieved and obtained. They are conditional in nature, and we're working through those conditions as we speak. As Ian indicated yesterday, he's working through certain regulatory matters. We are doing the same. Our expectation is both on the acquisition of the bank, the registered bank, Class A. We will conclude that transaction shortly, imminently, and we are also working through what is the secondary part of the transaction, which is an acquisition of a portfolio of clients that will come from NCB Capital Markets into then NCB Cayman to be branded Clarion Bank and Investments Limited. So lots of activity, a tremendous amount of excitement insofar as the benefit to Clarion, the benefit to the group, and actually even more importantly, the benefit to our clients existing and both prospective in nature is one of scale. So Clarion, as the chairman reminded me yesterday, NCBFG acquired an interest in Clarion, a preeminent jurisdiction and a preeminent wealth management brand. And what we have now is the opportunity to take that preeminent wealth management brand and expand it into Cayman. We are excited by that. We have the tools. I often say when we talk about the value proposition that we bring to the table, it's a combination of excellent people, excellent platforms, and excellent products. And if you can bring that and bring that well and deliver it with a degree of client centricity that our group chairman has referenced as well as our group CEO, I believe that's a winning proposition. So I will be very proud, very pleased at the next quarterly investment briefing to hopefully declare the transaction to have been completed and that we are in the growth vector phase that we certainly are all looking forward to.
All right. Thank you, Ian. Those are the questions that we have for this morning. So I'm going to now hand back over to our chairman, the Honorable Michael Lee-Chin, to close out our briefing.
So thank you very much again, ladies and gentlemen. As you can see, over the last 3 years, the bank really has done, the institution has done a wonderful job at turning the operations around, laying the foundation for growth, reducing debt, rebuilding confidence, and most importantly, working on the culture to make sure that we have consistent, sustainable, growing profits, balance sheet strength, dividends, and confidence in the marketplace. So I thank you very much for being here, and I thank the staff, management, shareholders of the enterprise for a job well done. And the work continues. Lots of work ahead, but we are up for it. Thank you.
Make secure and faster payments with NCB Pay. NCB Pay stores all your NCB credit and prepaid card and reduces fraud by hiding your card information when you pay. So you can just tap and go with your Android phone. Don't just pay. NCB Pay. Download today.
Today's woman is not just an entrepreneur, a mother, or the girlfriend that gets all the girls together. She's all that and much more. We call her a queen. She's driven to live life to the max, and nothing should slow her drive down. That's why Guardian General's Queen Guard Motor Insurance was created with this woman in mind. Delivering benefits like 24-hour roadside assistance, uninsured motorist protection, windscreen coverage, replacement of personal belongings, speedy claims settlement, and so much more at affordable premiums that won't break your pocket. For more information, contact your broker or call us at 876-935-6681 or toll free 888-468-3474.
When your business starts growing, sometimes the tools you rely on can start holding you back. It's time for an upgrade. Get road ready with NCB. Enjoy monthly payments as low as $12,033 per million borrowed. WhatsApp Wheels to 876-613-9160 to get started. Conditions apply.
In a world where scams lurk around every corner, NCB is working tirelessly to protect you. Beware of red flags such as scare tactics, too good to be true offers, and fake transaction alerts. Remember, NCB will never send links or buttons through texts, WhatsApp, or emails, and NCB will never contact you to ask for your PIN, password, RSA token, or card number. Don't fall for fraud. Visit jncb.com/protect yourself.
Life doesn't stand still. It moves fast. First steps, first decisions. Then it grows. Balancing today while building what's next. Opportunities open and you move with them. Because what you build should carry forward. With a partner that moves with you for life.
One already.
If your day goes like this,
Driver, I want to stop up the road here. Small up, please. Come, let's go. Driver!
it's time for your own car.
Get road ready with NCB. Enjoy monthly payments as low as $11,550 per million borrowed. WhatsApp Wheels to 876-613-9160 to get started. Conditions apply.
Make secure and faster payments with NCB Pay. NCB Pay stores all your NCB credit and prepaid card and reduces fraud by hiding your card information when you pay. So you can just